Imagine being able to look at a stock chart and instantly know where price is most likely to stop, reverse, or explode in one direction. Not because of luck, not because of news, but because of pure market psychology. That's exactly what the support and resistance trading strategy gives you. Support and resistance is one of the most powerful, most used, and most timeless concepts in all of trading, used by beginners and professional traders alike, because it's based on one simple truth. Markets move based on human behavior, and humans repeat the same actions again and again. When price falls to a certain level and repeatedly bounces up from there, that level becomes support. When price rises to a certain level and repeatedly gets rejected, that level becomes resistance. These levels act like invisible walls on the chart, created by fear, greed, and memory. Traders remember these prices. Institutions remember these prices. Algorithms are literally programmed around these prices, and that's why support and resistance works across all markets: stocks, crypto, Forex, indices, and on all time frames, from 1-minute charts to monthly charts. Support is simply a price area where demand is strong enough to stop price from falling further. It's where buyers step in and say, "This is cheap." Resistance is the opposite, a price area where selling pressure is strong enough to stop price from rising. It's where sellers step in and say, "This is expensive." But here's the key thing most beginners don't understand. Support and resistance are not exact lines. They are zones or areas. Price doesn't respect one perfect number like magic. Instead, it reacts within a range because different traders enter at slightly different prices. That's why professional traders draw support and resistance as zones, not razor-thin lines. When you understand this, your accuracy immediately improves because you stop expecting perfect bounces and start trading realistic market behavior. Now, the real power of support and resistance comes from one concept called role reversal. This is when old resistance becomes new support and old support becomes new resistance. This happens because of trader psychology. Let's say a stock keeps failing at $100 and dropping. That makes 100 strong resistance. One day, the stock finally breaks above $100. Now traders who miss the breakout wait for a pullback to $100 to buy. At the same time, traders who sold at $100 earlier regret it and also want to buy back at the same level. So what was resistance becomes support. This is one of the most reliable patterns in technical analysis and one of the highest probability trading concepts in the market. To identify strong support and resistance, you don't need indicators, fancy tools, or complex math. All you need is price. You simply look for areas where price has reacted multiple times in the past. The more times price touches a level and reacts, the stronger that level becomes. A level that worked once is weak. A level that worked 3 or 4 times is powerful. A level that held for months or years is extremely strong. This is why higher time frame support and resistance, like daily and weekly levels, are far more important than small intraday levels. Big institutions trade off higher time frames. Retail traders focus on small time frames. And guess who moves the market? Institutions. That's why smart traders always start by marking support and resistance on higher time frames first, then zoom into lower time frames for entries. Another critical detail is that support and resistance works best when combined with market structure. Market structure simply means whether the market is making higher highs and lower lows in an uptrend or lower highs and lower lows in a downtrend. In an uptrend, you want to buy near support, not resistance. In a downtrend, you want to sell near resistance, not support. Most beginners do the exact opposite. They buy near resistance because price is going up, and they sell near supports because price is going down. That's emotional trading. Support and resistance forces you to trade logically instead of emotionally, buying when price is cheap and selling when price is expensive relative to the current structure. Support and resistance also acts as a natural risk management system. When you buy at support, your stop loss goes just below support. When you sell at resistance, your stop loss goes just above resistance. This gives you tight risk and high reward. You're not guessing. You're placing trades where you are mathematically wrong only if price breaks a key level. This is how professionals think. They don't try to predict the future. They define levels where their idea is invalid and manage risk around those levels. That's why support and resistance isn't just a strategy. It's a framework for thinking like a real trader. Now let's talk about how actually to trade support and resistance in real life, not just understand the theory. There are 3 main ways traders use these levels: bounce trades, breakout trades, and retest trades. The bounce trade is the most basic and beginner-friendly. This is when price comes down into a support zone and you look for a buy, expecting price to bounce up, or when price goes up into a resistance zone and you look for a sell, expecting price to drop. The key rule here is patience. You never enter just because price touched the level. You wait for confirmation. Confirmation can be something simple like a strong rejection candle, a long wick showing rejection, or a shift in momentum on a lower time frame. Without confirmation, you're just guessing. With confirmation, you're trading probability. Breakout trades happen when price doesn't respect support or resistance and instead breaks through with strong momentum. This usually happens when there is high volume or strong news behind the move. When resistance breaks, it means buyers completely overwhelmed sellers. When support breaks, it means sellers completely dominated buyers. But the biggest mistake beginners make with breakouts is chasing price. They buy the exact top of the breakout candle and get trapped in a fake move. Smart traders wait for a retest. They let price break the level, then come back to test it from the other side. If old resistance holds as new support, that's your entry. This is called a breakout retest strategy, and it's one of the highest probability trading setups in the market. Retest trades are where professionals make most of their money. This is when price breaks a level, pulls back slowly, and then continues in the original direction. The psychology behind this is powerful. Traders who miss the initial move finally get a second chance to enter. Traders who are on the wrong side exit their positions, and big institutions use the retest to build massive positions without pushing price too far. That's why retests often lead to the strongest moves. If you master retests, you'll feel like the market is moving in slow motion, giving you clean and obvious entries instead of random chaos. One of the most important skills in support and resistance trading is knowing when a level is likely to break and when it's likely to hold. Strong momentum into a level increases the chance of a breakout. Weak, slow movement into a level increases the chance of a bounce. This is called a momentum context. If price crashes straight into support with big red candles, support is more likely to break. If price slowly drifts into support with small candles, support is more likely to hold. The same logic applies to resistance. This single concept can dramatically improve your win rate because you stop treating every level the same and start reading the story behind the price. Another advanced concept is something called support and resistance flipping inside ranges. When a market is ranging, price moves between support at the bottom and resistance at the top. Inside this range, you can buy near the bottom and sell near the top over and over again. But once price breaks out of the range, the entire structure shifts. The old range high becomes support in an uptrend. The old range low becomes resistance and a downtrend. This is how trends are born. Every major trend starts as a breakout from a range. Traders who understand this don't just trade randomly. They position themselves at the exact points where markets transition from consolidation to expansion. Finally, the biggest mistake traders make with support and resistance is drawing too many levels. They cover the chart with lines until it looks like a spider web. That kills clarity and decision making. The goal is to find only the most obvious, most respected levels. If you have to think hard to see a level, it's probably not important. The best levels jump out at you instantly. They're clean, clear, and respected multiple times. Trading is not about complexity. It's about simplicity, discipline, and execution. Support and resistance works because it's simple, visual, and based on real human behavior. And if you can master this one concept deeply, you'll be ahead of 80% of traders in the market. Now that we understand the basics and mechanics of support and resistance, let's dive into how to combine it with other tools to maximize your trading edge. While support and resistance alone can be powerful, layering confirmation tools makes your trades far more reliable. One of the most common combinations is with candlestick patterns. For example, a hammer or a bullish engulfing candle forming its support gives a much higher probability buy signal than support alone. On the resistance side, bearish reversal candles like shooting stars or bearish engulfing patterns signal a strong potential sell. Candlestick confirmation works because it reflects real-time battle between buyers and sellers at the critical level, giving you insight into market sentiment beyond just the zone itself. Another effective combination is using moving averages in conjunction with support and resistance. Moving averages act like dynamic support and resistance, especially on trending markets. For instance, if a stock is in an uptrend and bounces off a rising 50-period moving average that aligns with a horizontal support zone, that confluence dramatically increases the likelihood of a successful trade. Traders often refer to these points as confluence zones, where multiple factors line up, increasing confidence in the trade. Confluence zones reduce risk as the odds are stacked in your favor rather than relying on a single indicator or level. Volume is also a critical factor when trading support and resistance. A breakout with strong volume is much more reliable than a breakout on weak volume. Why? Because volume reflects commitment. High volume into a breakout level means a large number of participants agree with the move, whether they are retail traders or institutions. Conversely, low volume often leads to false breakouts or fakeouts, where price briefly moves past a level before reversing sharply. The combination of support and resistance with volume analysis allows traders to filter low probability trades and focus only on high probability setups. This simple addition can dramatically improve your consistency and profits over time. Risk management is another key piece of the puzzle. Even the best support and resistance setups fail sometimes, which is why stops are non-negotiable. A smart trader places stops just beyond the support or resistance zone, keeping risk tight and reward potential high. Many beginners make the mistake of placing stops too wide or too far away from the level, which often results in large losses instead of controlled risk. By defining risk up front and only entering trades with favorable risk-to-reward ratios, ideally 1 to 2 or higher, you protect your capital and ensure you can survive losing streaks. Over time, disciplined risk management separates consistently profitable traders from amateurs who take huge losses in one bad trade. Lastly, psychology plays a huge role in support and resistance trading. Patience, discipline, and emotional control are what turn a good strategy into consistent profits. Many traders see a level and immediately jump in, ignoring proper confirmation or market context. They chase price or exit too early out of fear. Mastering support and resistance means training your mind to wait for clean setups, respect the levels, and follow the rules. When you combine this disciplined mindset with precise level identification, confirmation tools, volume analysis, and proper risk management, support and resistance trading becomes not just a strategy, but a complete framework for navigating the markets with confidence, consistency, and clarity. Let's now bring support and resistance trading to life with practical, actionable examples and strategies you can actually use in real markets. Imagine a stock in an uptrend, steadily climbing and making higher highs and lower lows. You identify a strong support zone around $150 because price has bounced off this level multiple times over the past few months. Instead of buying immediately when price approaches $150, you zoom in to a lower time frame and look for a clear confirmation signal, perhaps a bullish engulfing candle or a small pullback followed by a strong green candle. Once you see that, you enter your buy trade with your stop loss just below the support zone, say at $148. Your first target could be the previous high around $160, giving you a clean risk-to-reward ratio of roughly 1 to 2. By following the support and resistance framework, you're not guessing, you're trading structured probabilities with defined risk. Now consider a breakout scenario. A stock has repeatedly failed to break $200 resistance over the past 2 months. One day, strong buying pressure pushes the stock above $200 with a long green candle on high volume. Instead of chasing the breakout immediately, a smart trader waits for a retest. Price pulls back to $200, and this level now acts as new support. Traders who miss the breakout buy at this retest, while others confirm the breakout's validity. You enter near $200 with your stop just below $198. Your first target could be $220 based on historical resistance or measured move techniques. This breakout retest strategy drastically reduces the chance of getting trapped in a false breakout, which is a common reason beginners lose money. Advanced traders also look for multiple support and resistance levels lining up, what's called a confluence zone. For example, a horizontal support zone at $120 coincides with a 200-period moving average on the daily chart and a Fibonacci retracement at 61.8%. When price reaches this area, the probability of a bounce is significantly higher than using any single factor alone. Entering trades in such high probability zones allows for tighter stops and higher confidence in the trade. These are the setups professional traders look for, because trading is not about being right every time, it's about maximizing profits when the odds are stacked in your favor. Finally, remember that patience is your secret weapon. Support and resistance trading is not about constantly being in the market, it's about waiting for high probability setups, confirming with candlestick patterns, volume or moving averages, and executing with proper risk management. By mastering these techniques, bounces, breakouts, retests, confluence zones, and higher time frame analysis, you create a trading system that is repeatable, disciplined, and profitable. This is why support and resistance is considered the foundation of all technical trading. Once you truly understand and apply it, you're no longer guessing at the markets, you're reading them like a pro. To truly master support and resistance trading, it's crucial to understand common mistakes traders make and learn the advanced techniques professionals use to stay ahead. One of the biggest mistakes is overcomplicating the chart. Beginners draw dozens of lines and zones, hoping one will work. This creates confusion and indecision. The key is simplicity. Identify only the strongest, most obvious support and resistance zones, preferably those tested multiple times or visible on higher time frames. Quality beats quantity every time. Another frequent mistake is ignoring market context. Buying at support in a downtrend or selling at resistance in an uptrend often leads to losses. Always trade with the trend, not against it, unless you're deliberately using counter-trend strategies with proper confirmation. Another advanced tip is to incorporate multiple time frames. High probability support and resistance trades usually align across time frames. For instance, a daily support zone that coincides with a 4-hour support level gives you stronger evidence that buyers are stepping in. Many pro traders start by identifying major zones on the daily or weekly chart, then move down to 1-hour or 15-minute charts to fine-tune their entries. This multi-time frame approach filters out weaker levels and increases trade accuracy. Similarly, combining support and resistance with momentum indicators like RSI or MACD can provide clues about potential reversals or breakouts. For example, if price hits a strong support zone while RSI is oversold, the odds of a bounce are higher than without that confirmation. One often overlooked concept is psychological price levels. Round numbers like $50, $100, or $1,000 often act as natural support or resistance because traders and institutions place orders around these levels. These levels often coincide with technical zones, amplifying their strength. Another pro-level technique is tracking volume at support and resistance. High volume at a level indicates strong conviction, while low volume suggests weakness and a higher chance of a fake-out. Experienced traders also look for divergence at support and resistance. For instance, if price makes a lower low at support, but momentum indicators show higher lows, it signals weakening selling pressure and potential reversal. Finally, patience, discipline, and risk management are non-negotiable. Even with perfect analysis, some trades will fail. Accepting this and sticking to your plan separates profitable traders from emotional ones. Always define your risk, use proper stops, and let winners run toward logical targets like previous highs or measured moves. Remember, support and resistance trading is not about being right 100% of the time. It's about trading in a way that the odds are consistently in your favor. When you combine clear levels, trend alignment, confirmation signals, volume analysis, psychological price points, and disciplined risk management, support and resistance becomes more than a strategy. It becomes a complete trading framework. Master this, and you'll have one of the most reliable tools in the market, capable of guiding your decisions, improving your win rate, and giving you the confidence to trade any market successfully.